Hello and welcome guys to session 4 of King 4 Corporate Governance. This is the final and last video in the series on corporate governance. So let's get straight into it. In this video we will be looking at principles 11 to 17. We are going to be attempting to understand what are in those principles and how we're going to apply it to our scenarios as well as in business. Before we actually get into any of the principles, I want to first show you this diagram that I've drawn up in which we actually are meant to take notes. So in this table, you're going to see that things that we need to look out for when we're going over these principles is what needs to be approved by the governing body, what can be delegated by the governing body and to whom can it be delegated, what must the governing body oversee personally, what kind of assurance is needed and on what the assurance is needed. And then finally, what needs to be disclosed by the governing body. Now in this table, I only have the first 3 principles that we're going to look at, but you can extend this table when you are taking your notes to all the principles that we're going to be dealing with today. So let's get into principle 11, the first principle that we're dealing with. This principle concerns itself with risk governance. Now risk governance is basically the governing body needs to look after all of the risks that are facing the entity. So the governing body is required to develop policies, procedures and protocols that assist the governing body in identifying different risks that may face the entity and also respond to those risks. This is what we call risk management. What is important is that when the governing body develops these policies, they then implement the policies in such a way that it becomes a critical part of the decision making that the governing body undertakes. So let's just briefly review some of the risks that the governing body may face. For example, stakeholder risks are risks that are faced by the stakeholder, but the governing body needs to consider. Reputational risks are the risks that the reputation of the entity may be damaged or there may be a loss of reputation by the entity. Compliance risk is the risk that the entity may not comply with any legislations, laws, or standards that are imposed upon them. Ethics risk obviously means that the entity is not acting in an ethical manner towards either themselves or someone outside. Sustainability risk is the risk that the entity may not be able to operate for the foreseeable future. And financial risk is the type of risk that you guys are very familiar with, which are the risks that relate to cash flows as well as going concern. These risks are easy for the auditor to identify and easy for those in finance to identify, but may be actually quite difficult for the governing body to identify. Now, there are many other types of risks that you will see in your textbook, and I would want to direct you to page 37, where the different types of risks are labeled and defined. But in developing of the policy, the governing body needs to take into account all the risks that may be affecting the entity or may be threatening the entity. After the governing body has done that, the governing body is then going to do what is called a risk assessment exercise. This is where the governing body looks at the different risks that are facing the entity and evaluates these risks. This risk assessment will result in the governing body being able to determine what types of risks are dangerous, and then also will give the governing body insight into what opportunities face the entity. So it can be positive and negative. It is very interesting that King 4 particularly asks governing bodies to look at the negative side of risks because it's very easy for governing bodies to only focus on what is good. Now, the implementation of the policy as well as the identification of risks can be delegated down to management, but ultimately the governing body remains responsible for this work to be done. The governing body should treat risks as an integral part of the decision-making process. It should also evaluate what is the company's risk appetite. When we talk about risk appetite, we're talking about how tolerant is the company to taking on risks. For example, you will know when you study math that you have an investor that is a risk-preferring investor or a risk-adverse investor. Risk-preferring means that the investor enjoys risk and likes to take risk, whereas risk-averse is someone who does not enjoy risk. So the governing body needs to decide what type of risk appetite the company has. Is it a type of company that enjoys taking risk or doesn't enjoy taking risk? Now, King 4 specifically asks the governing body to oversee the following aspects of the risk governance. For example, the governing body needs to look at opportunities and threats from the perspective of the 6 capitals. So for each and every capital, and we've gone through these capitals already, but for each and every capital, the governing body needs to identify what are the risks that are facing this capital in our business, and what opportunities do we have to expand and to grow the capital. We also need to know that the governing body's objectives in most profit-generating firms is to create a profit. But creating a profit is not always a good thing. For example, if an entity is working in the mining sector, creating a profit may put lives of workers at risk. It also may pollute the environment. So in achieving the company's objectives, the governing body needs to identify what risks or what threats arise. And if there is any damage to environments or to the people that work there, the governing body needs to address these risks and try and mitigate them. Assessing the relationships and the resources that the governing body uses in order to achieve their objectives is critically important, because we want to understand the relationship between different resources and different people and the entity. We want to eliminate any dependencies. That means if an entity is overly dependent on a specific person, maybe this is a key management person, then the entity would want to try and develop and improve the skills around that person, so that if something were to happen to that key management person, there is still someone to succeed that person and the entity can continue to operate. Now, many entities actually operate in highly volatile industries. So the entity will want to try and identify what risks are facing the entity from the industry perspective and from the business model perspective, and identify and develop responses to those risks. Overall, the governing body must oversee and implement policies and procedures that embed themselves in the organizational culture of an entity. This means that throughout the entity's operations, the entity is constantly looking to mitigate different types of risks as well as take advantages of opportunities that may arise. Continuing on with Principle 11, the governing body needs to have an audit of their risk governance. This can be done by an independent person. The King 4 report does not specify the time period for such a audit. Instead, the King 4 report just indicates that it needs to be done periodically, which means the governing body can decide on how often they have this independent audit done on their risk management and risk governance. So what does the governing body need to disclose with regard to risk governance? So the governing body needs to look at the natures and the extents of different risks that face the entity, and this needs to be disclosed. It also needs to be disclosed in such a way that no sensitive or confidential information is given to the public, because not only is the public going to be able to access this document, but also the competitors and people that want to take advantage of the risks that face this entity. It's quite important that while doing this disclosure, it's done in a way that doesn't harm the entity in the future. The governing body also needs to indicate what responses they have to these risks and how they plan to mitigate and eliminate the risks in the future. They can indicate the key focus areas that they're focusing on in terms of risks, and what areas that the governing body is planning to take risks, or what are their risk tolerance levels. And then finally, they can indicate where they plan to go with their risk management and risk assessment. So they want to also have a forward-looking, future-looking disclosure. Let's move on to Principle 12. So in Principle 12, here we are dealing with IT governance. IT meaning information and technology. So IT is a critical part of the entity. You will know that if a company does not employ technology in some form, then the company is not going to last very long and will disappear. If you take the example of a bank that refuses to use ATMs, or a bank that does not want to have online-based payments, ETFs, etc., they are not going to survive for very long, because technology is taking over all industries as we speak. And so the entities must be very comfortable with using technologies, but also they must use technology in a way that does not harm them, because there are some risks that arise when using technology, and also they need to keep their technology up to date, which is critically important. So that's what the governing body is going to be required to do. So the governing body wants to try and set a policy, set procedures, and they want to approve these procedures. And this is going to surround itself or concern itself with the IT governance of the entity. We want to, in this procedure or policy, we want to try and have a position created called the Chief Information Officer. Now, the Chief Information Officer is basically an executive that only looks after the strategic goals of the entity from a perspective of IT. This is a very critical role, and also someone who is highly skilled in programming and IT will be employed in this area. Because remember that IT, even though it's employed to achieve the entity's objectives, it should not be a standalone department or be standalone in the entity. It needs to be interwoven into the fabric of the entity and into the culture of the entity in such a way that it doesn't create problems, but it helps solve problems. So we want to be able to optimize the IT to achieve our company's goals, and we want to ensure that while doing that, we use IT in a responsible way. And that's what the policy of the governing body needs to encompass. So when we're looking at what the governing body can delegate, particularly they can delegate the implementation of the policy that they approve, they can delegate that to management. So the implementation will be done by management, which means management will be involved in the outworking of the policy, but the governing body is still supposed to oversee some specific areas of this policy. So what types of areas do we want the governing body to oversee? Firstly, the integration of people and technology into the processes of the entity. That is critical. So how people interact with the technology is critical. This may involve, but is not limited to, training people so that they can use technology correctly, ensuring that the technologies and platforms that we use meet our needs so that people are able to achieve the company's goals with ease, and also ensuring that the technology, when used, does not create risks. Now, when we talk about IT risks, it's almost a separate subject all on its own. So you guys will know that IT poses certain cybersecurity risks. Cybersecurity is the act of keeping oneself safe on the internet, or keeping oneself safe when using technology. So you will know that it is critically important to ensure that data is kept safely and stored in a way that does not damage it physically, but also that the online access that a company may have to the internet is also a secure and safe line. And so this is of paramount importance to governing bodies and to companies today. We can have certain technical tools that we use for such defense mechanisms. We can use firewalls, we can use hacking prevention software and antiviruses, but it is critically important that if the governing body does not set the tone on cybersecurity, then it may arise that this risk gets through. So we want the governing body to oversee the risks that IT might pose. The next thing that the governing body needs to oversee is how the IT is providing business resilience for the company. That is something that has become more and more important given the current crisis that we are going under in a global standpoint. We want businesses to be able to utilize technology in such a way that it creates a stronger business. And so that's what we're looking for, and the governing body needs to ensure that that is implemented and that is in their policy. Now, in some cases, you may have a situation where the governing body outsources the IT function to a business. What is critically important is that the governing body monitors that relationship between the person that is being outsourced to and the meeting of the entity's requirements. So we need to ensure that there's a proper service agreement in place. We need to ensure that the company that is used is reputable. We need to ensure that they are able to perform and deliver on their goals. And so this is very important. Another thing that the governing body needs to oversee is that there is continuous investment in technology. You will know that technology is very expensive. But not only that, it also becomes outdated very quickly. So the entity will need to continually invest in good technology that gives it the most useful life, but also not to just invest once, but continually invest. Talking about investment in old technology, When you invest in newer technologies, you have to find a way to dispose of the old technology and the old software. This is very important because we don't want anyone to get a hold of the information that we have on that old software, that old hardware. Disposing of old technology in a responsible way is also something that the governing body needs to oversee. On a periodic basis, King 4 recommends that the governing body gets an external IT audit. That means that someone comes in and has a look at the IT structure of the entity and then determines if there are any risks and what opportunities the governing body needs to be aware of. So when we talk about IT, something comes up in our minds, and that is intellectual capital, one of the 6 capitals. We need to ensure that our intellectual capital, which is only stored on our IT system, is secure. We don't want anyone to interfere with it. So we want to ensure that it's accurate and complete. That means it has good integrity. We want to ensure that it's available to the people when they need it. So the right people, when they need the intellectual capital in order to do their jobs and to achieve the entity's outcomes, we want to ensure that they have availability to it. And then also confidentiality. So in South Africa, we have the POPI Act, which tells us that we're not allowed to share specific information of people, and we need to ensure that the confidentiality of that information is kept. So with regard to disclosure around IT governance, the governing body needs to disclose exactly what threats they face from a IT perspective, what investments they've made in IT, and what challenges they face going forward. So they need to have also a future look at IT. Most important is their actions in order to develop and maintain good IT structures, but also the data underlying the IT is also critically important. So these are the things that the governing body needs to disclose. Let's move on to Principle 13. Principle 13 is what we call compliance governance. Now, compliance governance is the governing body's ability or the entity's ability to comply with laws and regulations. So the governing body needs to develop a policy that actually indicates what rules and what laws the entity is going to comply by. It is emphasized by King 4 that the governing body include non-binding rules, codes, or standards. Now, these are rules, codes, or standards that are not law. For example, a governing body may choose to comply with IFRS. Now, IFRS is the accounting standard. It is not law, but the governing body can choose to comply with it as if it is law. And so this is the type of information that we will find in the policy that is developed by the governing body. As we come to expect, the implementation of the policy can actually be delegated down to management. But remember that the articulation of the direction as well as the overseeing of the direction of the policy is remaining with the governing body. So what exactly is the governing body required to oversee? Specifically, they need to ensure that there is compliance with all laws and regulations that are binding on the entity, but also those laws and regulations that are not binding. So this is where we need to look at the governing body actually taking the spirit of the law instead of the letter of the law. So they need to go above and beyond what the law requires and comply with the spirit of the law as opposed to only what is written down. And this is where we get an understanding of the governance profile of the entity, because entities that are not willing to go above and beyond what the law requires indicates that they don't have a strong governance profile. One of the things that the governing body needs to look at also is a holistic view of laws and regulations, how they all interact. And instead of looking for loopholes, the governing body actually needs to look for areas in which they complement each other and abide by the laws, rules, and regulations with that sort of mindset. The other thing is, in any given business environment, there's constant change. And even though regulation changes slowly, there is still change in the regulatory environment of entities. And so the governing body needs to monitor all changes that are happening in the environment of the entity and then amend and change their policy, and which can then be delegated to management. So these particular things that the governing body is overseeing, you can see that they actually relate to amendments that may be made back to the policy that we dealt with in point 1 that the governing body approves. So it's really a forward-looking, a future view of the compliance governance of an entity. On a periodic basis, the King 4 report recommends that the governing body has a compliance audit, which is where you get an auditor that particularly looks at how the governing body is complying with laws, regulations, which are binding, but also those non-binding rules, codes, and standards. And in terms of disclosure, the governing body needs to indicate what types of arrangements they've made for compliance and how they plan to comply. They need to indicate what key focus areas they have in terms of regulations and compliance. And then they need to indicate what actions they've taken in order to implement compliance at a basic level. So from their staff members all the way up, how do they plan to comply with laws and regulations? Very interesting though is that in this principle, the governing body has to indicate what they have done wrong. So they need to indicate what penalties they have attracted, what sanctions, what fines, what contraventions they have attracted in the last 12 months. Where has the entity gone wrong? And so this is what needs to be disclosed in this section of their disclosure. Also note that King 4 particularly asks the governing body to indicate what they have done wrong, even under non-binding rules and codes. So as we mentioned at the top, the governing body will decide on certain rules, codes, and standards that are not binding, they're not law. But if they have done something wrong that go against those rules, codes, and standards, they still need to disclose it here, where they indicate what they've done wrong. And so this is what compliance inspections talk about. So we need to have a complete understanding of how the governing body is acting in terms of compliance. Also, if this is a year where the governing body has had an external compliance audit, as mentioned in gray in the previous point, the governing body needs to indicate what were the results of that inspection. So ideally, what the governing body needs to do is they need to implement a policy and develop a policy that embeds day-to-day, medium, short, long-term decision making. All of the decision making needs to take full responsibility for compliance with laws and regulations, as well as non-binding rules, codes, and standards. So it needs to be embedded into the culture of the entity and into the organizational culture. So it's really something quite important that the governing body needs to lead on. And if the governing body indicates to the rest of the employees and the executive that compliance with laws and regulations is important to them as the governing body, they are setting the example, it becomes a lot easier for other people in the entity to actually comply with laws and regulations. Okay, let's move on to Principle 14. So in Principle 14, we are dealing with remuneration. Now, this is something that is very important in South Africa because in the last few years, we've actually had major scandals, corporate scandals, in which remuneration took a focal point. So how much people are getting paid, more particularly how much executives are getting paid in relation to those that are lower down in the entity. So fair and responsible remuneration is something that is interlinked with good corporate citizenship. As a result, King 4 has emphasized that the Social and Ethics Committee, together with the Remuneration Committee, looks at how much executives and directors are being paid in relation to how much lower staff members are being paid, or people at the bottom. We need to have a ratio that looks at the highest paid versus the lowest paid in an entity, basically. So let's just remind ourselves that this specific principle, Principle 14, actually has their very own committee that is called the Remuneration Committee. And in the Remuneration Committee, the chairperson needs to be an independent non-executive director. There needs to be a minimum of 3 members, and all of those 3 members need to be non-executive directors, and the majority of them need to be independent. It's important to note that this particular Principle 14 links in with Section 30 of the Companies Act. So when we deal with Companies Act later on, come back to this principle and review this principle because they will be tested together. The governing body needs to develop a remuneration policy. A remuneration policy is basically a document that indicates how the governing body attempts to remunerate people in a responsible and fair manner. The governing body needs to assume responsibility for setting the direction for how remuneration will be approached and addressed in the entity as a whole. The governing body should approve a policy that articulates and gives effect to the direction and ensures that the direction is fair, responsible, and transparent. So, what exactly needs to be in this remuneration policy? Firstly, the remuneration policy needs to indicate how they plan to achieve strategic outcomes, how their remuneration is going to meet and develop their strategic outcomes, how the remuneration policy plans to attract, motivate, reward, and retain good human capital. So those people that are key and those people that are working hard. It also needs to indicate what positive outcomes are going to be promoted and how are they going to be promoted. It must ensure that there's an ethical culture that is created amongst everyone, and remuneration needs to meet that ethical culture, which also ties back into good corporate citizenship. So even though the remuneration policy must ensure that executives are being remunerated in a fair and responsible way, it critically draws attention to those that are the lowest paid in the entity, which is quite a big shift from what we've seen in the previous King reports. Now the governing body is actually required to concern themselves with who is being paid the least in an entity, and they need to consider the pay of those people particularly. The governing body also needs to consider the use of performance measures. Now, performance measures can sometimes be share price or revenue generation. The King 4 report asks them to look at the positive outcomes of using such measures, but also the negative outcomes of using such measures. So, after all of this, the remuneration report cannot be approved and implemented by the governing body before they have gotten the approval of shareholders. Remember, in an entity, the shareholders decide on the remuneration policy. The governing body in this principle is only required to develop the policy and create the policy. And once they are happy with it, then they approve it and take it to the shareholders for final approval. So it's critically important that you understand that the governing body does not have absolute power in this principle. King 4 wanted to really try and encompass all the different types of remuneration that can be given to executives as well as employees. So they went through an exercise of determining different types of remuneration. So let's have a look at a few of them. For example, retention benefits, which means a benefit to try and keep someone from moving jobs. Then a basic salary that many of you all will be familiar with. Commission is where you are being paid a variable salary based on the work done. So your work and your pay directly link to each other. Sign-on bonuses are bonuses that people get paid at the beginning of their starting to work. Severance benefits are those benefits, sometimes called termination benefits, when an employee leaves the employ of their employer, they generally get paid a specific amount called severance benefits. Shares, performance bonuses, and then share options you will learn about in honors, where we deal with share-based payments. Share options are where you give an executive or an employee an option to buy a share, but only after a specific thing has taken place. They are quite a complicated type of remuneration, and they will require more consideration by yourself. Many directors actually only receive what are called directors' fees, and so King 4 also wants to pull those directors into their ambit of remuneration. So far we've dealt with the remuneration policy. Now I don't want you to confuse this with the remuneration report. The remuneration report is a report that is created and given to the general public, whereas the remuneration policy is an internal document that the governing body creates, and then after the governing body creates it, the governing body takes it to the shareholders, which the shareholders will then approve. This document sets the direction, so the remuneration policy sets the direction for how an entity plans to remunerate, whereas the remuneration report actually indicates to the public how this policy was implemented. This remuneration report has two parts. It has the remuneration report part, or the general part, as well as the implementation part. Some entities break it up into two reports, and so they have the remuneration report and the implementation report separate from it. But many actually have one report, which is just called the remuneration report. They have a general section and then a implementation section. Under the general section, it's really just describing to the general public what the policy is, what the remuneration policy is, the thing that we dealt with in the previous slide. So that's really what the general section of the report is doing. So, for example, it will indicate what types of factors the governing body took into account when determining the remuneration policy. It will indicate what pressures the governing body has. It will also indicate what were the implementation outcomes of the policy, including how did the shareholders vote on the policy. Did they accept the policy or did they not accept the policy? It will indicate how the policy plans to be changed in the future. If there are any objectives indicated in the policy, it will also be indicated here. And then King 4 specifically gives us some key tips of what we need to have about the remuneration policy. So the first thing it says is that we must indicate what are the different mixes of remuneration. So is someone receiving a basic salary and commission, or is someone receiving share options and a basic salary? We want to try and understand who is receiving what. So it's not detailed, so it won't give every employee's name, but it'll just give a general overview of the type of employee. And that's why you'll see many employers, what they do is they create grades. So you'll have like grade A, and everyone in grade A will receive a little bit of basic salary and then a little bit of share options, for example. And so that's what we need to try and display or try and indicate to the public. It will particularly focus in on the top management, the executives. It will indicate what types of contracts are in place and how much they are being paid. If there are any performance measures that are being used, it will explain why these performance measures are being used and how those performance measures are implementing and promoting fairness and responsibility and transparency of remuneration. If there are any difficult calculations that need to be made in order to achieve the remuneration number, this is where those calculations will be done. It will indicate how actual fees or salaries are calculated and what benchmarks are used for the performance evaluations. In addition, the justification of such performance evaluations are normally done here. So they will indicate what the process is for performance evaluations and what are the metrics. When we talk about performance evaluations, what we are doing is we are trying to assess how individual employees have performed at their job. So each and every employee will then be evaluated by their line manager, and the line manager will indicate has the person met the outcomes or not met the outcomes. Based on that, the remuneration for that particular employee will be determined. So let's move on to the implementation report. So under the implementation report, what we find is that the implementation is actually delegated to management. In different tables, the implementation report will indicate the single and total figures of remuneration received by the top 10 earners at the entity. It will also give the fair value of such remuneration. The details of all awards made under variable remuneration incentive schemes will also be indicated during the period. An account of the performance measures used and the related weighting of each of the measures, as well as the results of the measures, will also be disclosed for executives. This particular report, the remuneration report, focuses in on the remuneration of executives. In this report, what you will find is a discussion of each and every member of top management, and their actual salary will be disclosed to the public. So the salary of the CEO, the salary of the CFO will be disclosed to the public in this report. So far we've dealt with 3 documents. We've dealt with the remuneration policy, which is, remember, an internal document. We've dealt with the remuneration report and the general section. And then in some companies, they'll break up that report into a remuneration report and an implementation report. So that's the 3rd document that we've dealt with. Now let's move away from documents and let's talk about voting. So Once the directors have developed and created a remuneration policy, they need to take it to the shareholders for voting. So the shareholders then will determine whether the remuneration policy is accepted and whether they are happy to disclose the remuneration report and implementation report. This normally happens at the AGM, which is the annual general meeting. 75% of all shareholders at the meeting need to agree with the remuneration policy and the disclosure of the reports. The remuneration policy will generally have a section in which it will discuss what will happen next if they do not get 75%. So if 75% agree, then less than 25% disagree. Now the remuneration report will set out guidelines for what needs to happen if 25% of the shareholders disagree. How will these shareholders be engaged and what will be discussed with these shareholders? All will be contained in the remuneration policy. This is because when the shareholders receive the remuneration policy, those people that disagree can review what discussion points may be brought up and also prepare themselves for that discussion. So let's move on to Principle 15. Principle 15 is dealing with assurance. Now the first idea that is created here in this principle is the idea of combined assurance. Combined assurance is where an entity has assurance from different people. Now we have a list of different people that can give an assurance. For example, we may know the external auditors or the internal auditors. We can also have lower management that can give us some sort of assurance on items, company or industry specialists, as well as government inspections or external inspections. Now these are different people that give assurance. In any one document, we want to have multiple levels of assurance, meaning that more than one person needs to give us assurance on it. But when we talk about assurance, what are we talking about? We are talking about the adding or creating of credibility. We're making reports or documents more believable. When we add credibility that something is factually correct or accurate, we actually then are enabling the users of that document to use the document to make critical decisions. So it's very important that the entity has multiple layers of assurance on any given document. And that is what combined assurance is. So one area of assurance that is very important are the external reports. When we talk about external reports, we talk about reports that are issued by a company and that exit the company and go to the general public or other stakeholders. Now, the governing body is responsible for ensuring the integrity of such reports, and they set the direction on how assurance will be achieved for these reports. They will need to develop this direction, ensuring that they comply with legal requirements that require assurance. For example, a financial statement, or what you would call annual financial statements, AFS, are actually an external report that are given to stakeholders. The governing body needs to set clear directions for how assurance will be obtained on these financial statements. For example, governing bodies may require that financial statements are audited by an external auditor. That is an example of how the governing body is setting the direction for how to achieve assurance. When achieving assurance, the governing body needs to keep in mind the following. The underlying data that supports the external report needs to be analyzed and assessed in order to achieve accurate assurance. In the case of a financial statement, this means that the auditor would look at the accounting records of a company to determine if the AFS accurately reflect what the accounting records are saying. The governing body may also need to consider the nature, scope, and extent of assurance. This means that the governing body specifically concern themselves with the audit strategy and the audit plan of the assurance provider. The specifications of applicable criteria for the measurement of evaluation of the report is important. So that means that governing body members need to indicate to the assurance provider what sort of standards or rules they comply with when obtaining assurance. This means, in our example for financial statements, the governing body should ensure that all auditors are practicing the ISAs, or International Standards for Auditing. The governing body should satisfy themselves that all external reports received combined assurance before they exit the entity. They are ultimately responsible for the integrity of these reports, so it's critically important that the governing body limits their risk by ensuring combined assurance. If we look at our example of financial statements, the governing body will ensure that financial statements have an internal auditor. They will also ensure that there's an external auditor. They will ensure that managers as well as other members of the entity agree with what is being said in the financial statements. This ensures that the governing body has combined assurance over financial statements. So with regard to disclosure, in the actual report that the governing body is ensuring has assurance, the governing body needs to indicate what type of assurance is obtained and how these assurance providers and assurance opinions relate to what the legislation or the law requires. This, for example, in a financial statement would mean that the governing body will require the audit committee to indicate that the external auditor was contracted to perform the duties of assurance, as well as you will have a report from the external auditor included in the financial statements. You will learn a little more about audit reports later on in the year. Governing bodies need to ensure that all external reports are reliable. This means that the information contained in external reports are valid, accurate, and complete. In addition, they need to ensure that the external report is useful to its users. That means that the information is relevant, consistent with prior years, and are measurable across years. The next area of assurance that we want to focus in on is the internal audit. Now, the internal auditors are auditors that report directly to the governing body. The oversight of the internal auditors is normally delegated to the audit committee, but ultimately the governing body remains responsible. The board must set the direction for the internal audit and ensure that the internal audit works effectively to achieve governance, performs risk management processes, and assesses the controls of the entity. The board can provide what is called an internal audit charter. The internal audit charter is a document which sets out the roles and responsibilities of the internal auditors, as well as the authority given to the internal audit department. The role of the internal auditor needs to be clearly defined within the combined assurance framework. In addition, the governing body should specify the standards that need to be complied with by the internal auditor. The board should ensure that the internal auditors have the requisite skills and experience in order to deal with the complexity and volumes of the company. They also need to ensure that if there are not enough skills or competence in the internal audit function, that these are supplemented by specialist service. Maybe a forensic auditor or maybe a special assessor needs to come and assist the internal auditor. The head of the internal auditor is called the Chief Audit Executive. The Chief Audit Executive plays a pivotal role in the functioning of the internal audit. Therefore, the governing body needs to ensure that the Chief Audit Executive is independent of management because their role requires them to assess management's performance. They also need to have the necessary authority in order to perform their duties. The appointment of the Chief Audit Executive needs to be made while considering the skills and experience that may be required to execute the duties. The board should ensure that the individual involved in the Chief Audit Executive has the necessary skills but also has the necessary objectivity. How can we ensure that the internal audit executive is independent? Well, the first is that the internal audit executives should have direct access to the chairperson of the audit committee. The internal audit executive should not be a member of executive management and should not attend meetings that he is not invited to. He may attend executive meetings, but only by invite. In addition, the internal audit executive reports directly to the chairperson and the audit committee. They do not report to executive management. The only reason that they will interact with executive management is for administrative reasons. In some cases, you might have the internal audit function outsourced. That means that you get an external company to perform the work of the internal auditor. In this case, we need to clarify who is the chief audit executive, whether that person is appointed by the entity or the outsourcing company, and what exactly are their roles. The board of directors not only can appoint a chief audit executive, but they are the only one that can remove a chief audit executive. So the executive management cannot make that decision on their own. The board should obtain confirmation annually from the chief audit executive that the internal audit conforms to professional codes of conduct. The board should monitor the performance of the internal audit and the chief audit executive on an ongoing basis. The board needs to ensure that the internal audit department provides a risk-based internal audit. What is a risk-based internal audit? Well, broadly speaking, there are two types of audits. One is compliance-based, one is risk-based. Compliance-based is the type of audit that ensures that it meets the minimum requirements for laws and regulations. In addition, compliance-based will audit the entire company, giving an even spread of audit assurance across the entire entity. This means that the auditors may be involved in auditing certain balances or transactions that are not inherently risky or do not pose an audit risk. This is the way many audits were conducted previously. This type of compliance-based audit does not require a risk assessment to be done. However, a risk-based audit is an audit where the auditor needs to assess the different audit risks that are in place. Once the audit risks are assessed, the auditor will then audit those specific risks. This is very similar to a sniper. If you look at a sniper picks a target and hits that target. In a similar way, an auditor needs to do that. He needs to identify the risks and only attack those risks. This means that vital internal audit resources are used wisely to only tackle areas that may be risky. And the assurance spread is not wasted on areas that are not risky. This may mean that there is a weighting given to different balances and transactions, with transactions that are more risky receiving more attention from the internal auditor. In addition, the risk-based audit also gives the internal auditor a clearer picture of what exactly are the risks that are facing the entity. They are able to calculate the risk frequency and the potential of impact from each risk. This is why the board of directors need to ensure that the internal auditor is performing a risk-based audit. Over time, the internal auditor will have to change their audit plan in order to meet the changing organizational risks that are faced. On an annual basis, the internal auditor will have to confirm that they have met the governance and risk management processes that are required by the board of directors. In addition, every 5 years, the governing body should contract with an independent quality reviewer to review the internal audit function. Let's move on to Principle 16. Principle 16 is talking about stakeholder engagement. Now, there are many types of stakeholders that the entity may face. For example, you may have suppliers, creditors, employees, government, and external auditors. In addition, you may have the industry at large that the entity operates in, the local communities that are impacted by production as well as operations, the media, who are sometimes used as whistleblowers or used to get out vital information, investors, who are sometimes called shareholders, and also future investors. The governing body is required by Principle 16 to engage these stakeholders in decision making and to ensure that their interest and expectations are taken into account when the entity makes decisions. So the governing body is ultimately responsible for the governance of stakeholder relationships. They set the direction for how stakeholders should be approached and contacted. The board should approve a policy that articulates how exactly the entity is attempting to contact and engage with stakeholders. Now, the implementation of this policy may be delegated down to management. As always, the governing body still remains ultimately responsible. What does the governing body need to specifically oversee? The first thing is the governing body needs to specifically oversee the methodologies that are used in order to contact stakeholders. For example, one may use the media, another one may use a website. People also may use WhatsApp or social media. So these things need to be coordinated in such a way that there is a uniform discussion between the entity and stakeholders. The second important thing that the governing body needs to oversee specifically is how stakeholders are identified. More importantly, how material stakeholders are identified. They want to be able to identify all important stakeholders. Why? Because this can minimize or eliminate harm to the entity's reputation. A formal mechanism needs to be developed for the communication and engagement of stakeholders. If there is a case where there is a dispute between the entity and stakeholders, then they need to implement dispute resolution. Dispute resolution is where the entity personally approaches the stakeholders that have a dispute against them. They then attempt to negotiate a settlement. If this fails, we then need to implement what is called alternative dispute resolution. We discussed alternative dispute resolution in video 1. Alternative dispute resolution is simply a negotiation or discussion that has an arbitrator or an adjudicator that mediates between the two conflicted parties. The governing body needs to emphasize proactive engagement with stakeholders, including shareholders, at the AGM. All directors need to be present at the AGM so that the entity is able to effectively communicate with shareholders. In addition, the external auditor needs to also be available for the AGM. The governing body should ensure that all stakeholders, including those that are minor stakeholders, are treated equitably and their interests are taken into account. For public companies or companies that have a public interest, the AGMs should be made available to the public. What does the entity need to disclose? The entity needs to disclose how the governing body plans to engage with stakeholders and what is the status of the stakeholder relationships. Key areas of focus need to be indicated, as well as how they plan to effectively monitor stakeholder management. One very key stakeholder in an entity is the group companies. Now, this may mean subsidiaries or holding companies. The governing body needs to indicate how they plan to maintain and improve relationships within group companies. They need to ensure that subsidiaries also engage with their own stakeholders. If there's an agreement that is made in the group, this needs to be disclosed. Let's move on to Principle 17. Principle 17 was created after the 2008 financial crisis. This principle aims to mobilize all of the shareholders into an organized group. Now, the most powerful shareholder in South Africa and around the world is what we call institutional investors. Institutional investors is a company or organization that's main goal is to hold and earn income from shares. If we look at the South African economy, proportionately, institutional investors such as medical aids and pension funds hold the most number of shares on the JSE. This gives these institutional investors a large amount of power. Principle 17 aims to get these institutional investors to work together and to invest in companies that promote good governance in the economy. So just to recap, institutional investors are companies that are unit trusts, pension funds, or medical aids. The board of the institutional investor needs to provide direction for how investments are going to be made in a responsible manner. They need to indicate what sort of investigations will be done into the companies that they invest in, and how will they make sure that the management of these companies are acting in an ethical way. Now, the implementation of this policy can be delegated down to management. In some smaller institutional investors, this may be outsourced to what is called a professional investor. This is a different company that actually takes money from individuals and invests it on their behalf. In the past, we sometimes refer to this person as a broker. In the event that an institutional investor outsources their investment activities to service providers, for example, asset managers, the board should ensure that the formal mandate is set in place that clearly sets out the company's investment policy. The board should also ensure that these outsourced service providers implement this investment policy. In terms of disclosure, the board of institutional investors need to disclose what exactly the investment policy is that they have approved and how they have adopted it and implemented it in the financial year. This will ensure that institutional investors are able to push the economy to create greater corporate governance. Thank you. That's the end of session 4, which is the last session in the corporate governance series of videos. I want you to stay tuned for other videos that may be on my channel. Bye-bye.